Okay, so good morning once again. By way of review, we were looking at the different principles, the most important principles as far as the role of finance is in the corporate setting. We said that the other principles of finance is built on these three basic principles: the investment principle, the financing principle, and the dividend distribution principle. So let's quickly review what we have discussed so far. Okay, as regards, as regards investment principle is concerned, we said that it's important for a firm to determine in what industries or in what type of investments they're going to engage in. And it requires that the company computes for the expected cash flows and determine the return of the project based on those estimated cash flows. And a company should compare the returns with a certain benchmark called the weighted average cost of capital or the hurdle rate to determine whether a project is feasible or not. We said projects can be either mutually exclusive or independent. When we say mutually exclusive, the choice of one project negates the other projects. So we only choose one. On the other hand, if they are independent projects, then we say that we can choose several projects at the same time. The only constraint here is that the budgetary constraints of the company. For financing principle, we said that it's important for the firm to determine what's the optimal capital structure. So is it 70% debt, 30% equity, or is it 30% debt, 70% equity? The answer to the question as to which is the optimal capital structure for the firm is dependent on the optimal capital structure, on the capital structure that optimizes that maximizes shareholder value. That's the answer, guys, to that question. So there's no one magic bullet, one formula for the optimal capital structure. One firm might have 40-60, another firm might have 60-40. Okay, and lastly, we have the dividends and return of capital. The finance department has to determine whether it's better off for the company to return the cash flow to their investors, okay, in the form of dividends, or flow it back to the operations to flow back for the use of operations. Okay, so we looked at this last time. As far as the financing decision is concerned, we said that a company that's highly leveraged, for example, 80-20, might find it difficult already to borrow money from financing institutions, because a very highly leveraged company would mean that it's more risky for the ones lending the money. Okay, a lender, a financial institution that lends money, will do due diligence, and one of the measures that they will look at is the capital structure. If the capital structure is relatively high, I mean the debt ratio is relatively high, then either the company would not lend the borrower funds, or they would lend it, but they will require a higher interest rate, because we learned last time that a company that assumes a greater amount of risk should be compensated for doing that and will require a greater amount of returns. Okay, so we looked at this, guys, the meaning of being leveraged, and we said that when we compute for the weighted average cost of capital, we noticed that the formula is the weight times debt times cost of debt times 1 minus tax rate. The reason for that is that the use of debt, okay, with the use of debt, the company incurs interest expense, okay, and the interest expense actually lowers the taxable income, and so there's tax savings because of the use of interest. So there's leveraging in as far as as far as tax savings is concerned with the use of debt. Okay, not to mention, guys, that companies usually do not have all the funds that they will need in order to engage in projects. So they will really be needing more financing. And there's this option to tap resources coming from lenders. There's an advantage, number one, of leveraging the operations of the company through tax savings. And number two, a company that has a good credit history, guys, is able to borrow more funds. So if it has a history of borrowing and it's able to pay its obligations, interest and principal payments, then it will have a good credit score. And when there's a time that the company needs to borrow for a big project, then it will be able to do so even at a low cost because of its past credit history. Okay, so let's quickly review, guys, the principles that we discussed. The first principle is the investment principle. And we say that in this principle, we determine where the business invests its resources. Okay, saan ipapasok yung pera ng organization. So the general rule is that a firm should invest in assets and projects that yield a return greater than the minimum acceptable hurdle rate. And this minimum acceptable rate is, we know this to be this is our WACC, okay? The weighted average cost of capital. Okay, so if a company will invest in assets, then the general rule is that the return of that asset or the return of that project should be higher than the weighted average cost of capital, which we define to be equal to, okay, the weighted costs of their financing, which is the weight of the debt times the cost of debt times 1 minus tax rate. So this is where the cost of debt, guys, is we have a reduction as far as the cost of debt is concerned. If the tax rate is 30%, then we only charge 70% of the weighted cost of debt because of the tax savings that generated from the use of debt. So we add here the weight of common stock times the cost of common stock, and if there's any, the weight of preferred stock times the cost of preferred stock. Okay, so in general, that's how we compute for the weighted average cost of capital. And any project or asset the company invests in should have a return greater than the weighted average cost of capital, aka hurdle rate. Okay, so the hurdle rate should be higher for riskier projects and should reflect the financing mix used, owner's funds or borrowed money. So financing mix, guys, this is it, guys. The weighted average cost of capital should include the debt component and the equity component. So here we're including the formula, the cost of debt coming from lenders, creditors, and the cost of debt coming from shareholders, whether it be common shareholders or preferred shareholders. So this is what this means. The hurdle rate or the WACC should be higher for riskier projects. Why is that so? Because if the project is riskier, then the cost of debt, cost of common stock, and the cost of preferred should be higher. Okay, so that's what this means. Okay, so let's continue this. Now, how are the returns of the project computed? It should be based on cash flows. Okay, so we do not measure the income, the net income after tax, but we do use the net income after tax in order to compute for the cash flows. So after projecting the income statement, which results into the net income after tax, we have to convert this into cash flows. So we don't just use the net income after tax. We use the cash flows. Okay, because as we mentioned a while ago, as we mentioned in previous discussions, in finance, cash flow is king. Now, that should be the medium. That should be the measure by which we determine the viability of a project. Why? Simply because whether they are lenders or shareholders, they require cash in return. So creditors, of course, will be happy if the income statement is good, but they will say, yes, net income is good, but we need cash, okay? Because cash is the, well, that's the medium of transaction used as far as the sourcing of funds is concerned, okay? So also the timing, this is very important. So what do we mean by timing? We discussed this before briefly. We looked at the time value of money. That what would you prefer, guys? Let me pose this question to you. Okay, so I want you to answer this in the chat box. What would you prefer? 1 million now or 1 million after 1 year? Kindly chat, please, in the chat box. What's your preference? 1 million, just answer now or after 1 year. If I'm going to ask you guys, how do you prefer to get your money, your 1 million? Would you want it now or you want to get it after 1 year? Kindly chat, please, the chat box. Okay. All right. I think most of you answered now. Okay, correct. Justin mentioned that if I get it now, I'm able to invest it right away. Yes, you're correct, guys. So your decision is very sound. Okay, and I'm sure you chose that because money has cost. Money follows a certain principle, the principle of the time value of money. You would want to get it now because if you have the money now, you can put it in an instrument, in an investment, so that after 1 year's time, your 1 million would have grown, okay, as compared to getting your 1 million after 1 year's time. So that's very basic, okay? So when we take a look at cash flows, we don't just look at cash flows, but we also take a look at the timing of these cash flows. As I mentioned, I would want 1 million now as compared to 1 million after 5 years. So there's a difference between having your 1 million after 5 years or having your 1 million now. There's a difference. And when we take a look at finance principles, we have to consider this. Number one, we have to look at cash flows. Number two, we have to look at the timing of these cash flows. Okay, and we know that there's such a thing as positive and negative cash flows. Negative cash flows, which means money goes out. Positive cash flows, which means money goes in. Okay. Now, the second principle, guys, is the financing principle. This is just to summarize it. Okay, financing strategy is essential to the continuity of the business over the long term. Now, we mentioned this already before, that the financing mix or the capital structure is very important. And finance has to determine what is that capital mix or capital structure that maximizes the value of the investment made and match the financing to the nature of the asset being financed. So what do we mean by this? Okay, so we have number one, capital structure, capital mix, the one that optimizes the value of the investment, the one that optimizes shareholder value. And secondly, there's this principle of matching. Okay, so for example, we do not use short-term debt in order to finance a long-term. Okay, let me write that. So if we have a long-term project, assuming we have a long-term project, let's say this project has a duration of 20 years. Okay, now it's definitely wrong to use a short-term borrowing for this. Okay, so if this is 100 million, for example, if the cost of the project is 100 million, it is foolhardy, guys. It's not right to borrow, to have a borrowing of 1 year only. So we borrow money from a bank, for example, and the 1 million that we're going to use to finance the project, guys, we are using a short-term borrowing, okay, payable in 1 year. Okay, that's a very, very wrong practice. There should be a matching between the nature of the asset, the financing of the nature of the asset, and the financing itself. So generally, long-term projects require long-term borrowing. Short-term projects, guys, generally require short-term borrowing. Sometimes there could be a mixture of this, but generally, guys, pag long-term yung project, dapat long-term yung borrowing. So that's the matching principle. And as I said a while ago, any finance worth his salary should know this. Okay, it's very erroneous to finance a long-term project with a short-term borrowing. Nobody should be doing that. Okay. All right. Okay, this one, guys, another important aspect of financing principle is that, I'm sorry about the writing here, ensure access to constant inflow of capital, since the savings margin will not allow operations to continue for much longer without the support of additional liquidity. So liquidity is very important, okay? That's why one of the important functions of finance is cash management. It's important that any project, or for that matter, the basic operations of the business has to be supported by enough cash. Okay? What do I mean by enough cash? Kunyari, yung operations, the acquisition of the purchase of inventory, raw materials. If the company does not have enough cash in order to invest in these raw materials, then how can the company be sustainable? Okay, so whether it's for operational purposes or for long-term purposes, guys, it's important that finance should be able to deliver a constant inflow of capital. Okay, that's why one of the most important role of finance is cash management. We'll take a look at that in the next module. Okay, and then the third principle, guys, is dividend distribution. So we already looked at this before. This is one of the most important decisions that a financial manager has to make. Okay, and we know that this concerns the determination whether a firm will needs to distribute to their shareholders excess cash or to flow it back to the operations of the business. Okay, a company that's able to distribute excess cash to the shareholders signifies good performance as far as the operations is concerned. Okay, so okay, and then if there's not enough investments that earn the hurdle rate, return the cash to the owners of the business. So this is one very important principle. If there are no available projects and there's excess cash, then it's best to return the cash to the owners. Okay, in the case of a publicly traded firm, the form of the return, whether dividends or stock buybacks, will depend on what stockholders prefer. Okay, so it's very important for the firm to also understand what to do with the excess cash, because they can just park it somewhere without any use at all, or they can return it to the shareholders, because that will also send a very good signal that the company is able to generate excess cash flow. Okay, so that's very important as far as the dividend principle is concerned. Okay, so at its core, guys, finance is all about managing these funds within the organization, and then with a decision to either reinvest it or to distribute it to any of its any subsequent cash flows generated. Okay, so how does the company use these funds? Okay, in the use of the funds, guys, that's where investment comes in. Okay, so also where do this how does the company acquire these funds? That will be from the financing decision. And how should the company decide to invest or distribute any excess cash generated? That will be the dividend principle. So it will really go back to these basics, guys: the investment principle, the financing principle, and then the dividend decision principle. Okay, so let me just show this to you, guys. This is just a big picture. The objective of the business is to maximize shareholder value. So whether it be investment decision, financing decision, or dividend decision. When we talk about investment decision, the overall principle is that the company should invest in assets that return greater than the minimum acceptable hurdle rate, or this is your WACC. Okay, so we have discussed this before, that the minimum hurdle rate is the weighted average cost of capital. The hurdle rate, guys, should reflect riskiness of the investment and the mix of debt and equity to fund it. So that's why the formula, guys, the formula, okay, so I'm adjusting my digital pad. The formula of Wiki reflects this, guys, reflects the riskiness. So the cost of the finance, guys, reflects the riskiness. For example, generally, guys, cost of debt is cheaper than cost of common stock or cost of preferred stock. Of this financing, this is the cheapest. This is the most expensive. Okay, this is the second cheapest. Okay, so it means that it reflects the riskiness of the investment. By including, guys, the cost of debt, common stock, and preferred stock, we're actually including the riskiness of the investment. And the mix of these three, based on this formula, reflects the mix of debt and equity used to fund it. Okay, so the use of WACC, guys, answers this question. Okay, also the return should reflect the magnitude and timing of the cash flows. Okay, so that when we, for example, determine if a project is feasible or not, we normally determine the cash flows. Okay, so for example, for year 0, year 1, year 2, year 3, year 4. So quick question. If the project here was, let's say, it cost 1,000. Okay, here, after year 1, there's a cash inflow of 500. After year 2, there is 400. After year 3, you have 300. After year 4, you have 400. Okay, so let's assume that the term of the project maturity is 4 years. So this is the estimated cash flow. We're going to invest 1,000 now, and after 1 year, it will be 500. You get inflow of 500. After 2 years, 400. After 3 years, 300. After 4 years, on the 4th year, it's 400. Okay, may I ask you guys, should we invest in this? Yes or no? Paki-chat na lang, please. Kindly chat. Is this a good project? Is project A viable? Is it feasible? Yes or no, please? Okay, there's a question here from Lance. Can I get the 500 now and 500 next year? No, Lance, this is the cash flow. No, this is the estimated cash flow. So based on this estimated cash flow, should the company invest in this? Yes or no, guys? Yes or no? Yes, if you think the project is okay. No, if you think the project is not okay. This is just more of a brief assessment of how you appreciate, how you understand this investment decision making. Okay, I'm still waiting for your answers, guys. Kindly chat in the chat box. Is this a good proposition? Okay, I hope everybody gets to chat their answers in 5, 4, 3, 2, 1. Okay, no answer, guys? Anyone who would like to volunteer? Okay, is this project okay? The year 0 means it's an outflow. So you invest 1,000. And then after first, second, third, fourth, you get this cash flows.
Sir,
Yes.
I believe it's
Who's
both.
this?
Justin Gochan
Okay,
po.
Justin. Okay.
I believe it's seems like a very slow. How you say this? It's both bad and I guess you can say good out at the same time.
Okay. Okay. Thank you. Just why? Why do you say it's good and bad?
Because at the beginning, when you invest the whole 1,000, it just turns into 500, and then on year 2 you get 400. So obviously it's a loss. and
Okay.
goes into a loss again. But then on the fourth year, it starts to rise. And so I guess it's good because it might increase in the future.
Yeah, what do you
But
mean by loss, Justin? These are cash
oh,
flows, okay?
oh,
So
cash flow.
at the beginning, you put out 1,000. At the first year, you get back 500. Second year, you get back 400. Third year, you get back 300. And the fourth year, you get back 400. So these are positive cash flows from year 1 up to year 4. For year 0, you notice the parenthesis. It means that this is a cash outflow. But from year 1 up to year 4, these are cash inflows.
Oh,
Yeah. So
it
would you like to change your answer, Justin?
I would like to change it a little bit. I didn't
Okay, sige,
understand
sige.
the 1,000 part, but it's more on, yeah, it's almost the same because at year 1 it's 500, then year 2 it's 400, then year 3 it's 300. So you would notice there's like a decline, and at year 4 there's an increase again. So
Okay. So
it
you're
starts
saying,
bad and it turns into good.
okay, okay. But take note that the 500 here is not bad because that's an inflow. It's the cash that you get at the after 1 year, and then 2, at the second year you get 400. Okay, but for you, Justin, you think that this is going down, so it's okay. That's a very good assessment of this investment. So you will not invest here.
No,
No,
unless
okay.
I have like an idea of like what the first few years would be.
These are the first few years. The first year you get 500 cash. Second year you get 400. Third year you get 300.
If that's the case, then I don't think I'm willing to invest.
Okay, okay. So why?
Just because of how the first few years would start, and at the fourth year it's 400, and it feels a little uncertain. But
Okay,
better be safe than sorry.
okay. Yeah, thank you, thank you. Of course, that's a good point, Justin. Thank you so much for that. Of course, guys, any project will have really an uncertainty. You cannot really estimate 100% surely your cash flows. We're assuming that these are estimated cash flows, and finances, we're assuming that finance really did due diligence, a good study of the possible cash flows that the company will be able to generate based for this project. Okay, thank you, Justin. There was this other one, Lance. Were you raising your hand?
Oh, yes po. I
Sige.
think for me, sir, I think it's a good investment
Okay.
because if you accumulate all the cash inflows, it will accumulate to 1,600. So
Yeah,
you'll
okay.
earn like 600.
Yeah, thank you. Thank you. Yeah, that's a very solid answer. Because if we add all the cash flows, 500 plus 400 plus 300 plus 400, that gives us, you're correct, 1,600. And it's more than the initial investment of 1,000. Yes, thank you, Lance, for that. Now, I saw other answers here. How about Iana? You said no.
Hello, sir.
Yes.
I said no agad, mainly because when I look at the values, they could appear stagnant and the growth is like gradual.
Okay.
So, I think for this one specifically, I wouldn't invest
Okay.
because the numbers have a pattern of like increase and then decrease and then so on
Yeah.
and so forth. I think it would be a risk having information limited to these lang. So with that in mind, I wouldn't invest po.
Okay, thank you, Yana. Thank you. Well taken. Okay, so that's also a very good point. So for as far as Yana is concerned, this I think quite similar to Justin. Okay, the risk involved might be too high. Okay, so good things, guys. You mentioned, Lance mentioned something about the magnitude of the returns. Okay, and Yana and Justin mentioned something about the riskiness of the project. Okay, so the project is just has a life of 4 years only. Okay, and these are the estimated cash flows: 500, 400, 300, 400. Okay, now how do we address this? How do we answer this? How does finance answer this? Finance answers this by looking at this magnitude and the timing. Okay, as far as magnitude is concerned, 500, 400, 300, 400, this seems to agree with the answer of Lance. Okay, because if we accumulate this is 1,600. However, and the initial investment is 1,000. Now, however, okay, there's this very important principle of finance that says that it's the principle of the time value of money. That one peso today is different from 1 peso in the future. Thus, guys, how do we resolve this? How do we determine how if this project is feasible or not? Okay, in the next few sessions, guys, we're going to say that we cannot add this. Okay, we cannot add these cash flows because 500 after 1 year is not the same as 500 after 2 years, etc., etc. So how do we determine whether this project is feasible or not? Just by way of not really going to the computation of that. Now we cannot combine it with 1,000. Lance has the correct idea of netting all these cash flows because these are all cash. Okay, and we can net all cash and determine whether the net cash is positive or not. However, we cannot net these cash flows with 1,000 because 1,000 happens now. 500 happens is obtained after 1 year, 400 after 2 years, etc. So in order to look at the timing, not only the magnitude, but the timing of the cash flows, what we need to do is we have to convert the 500. How much is 500 now? Okay. How much is 400 after 2 years now? How much is 300 after 3 years now? And how much is 400 after 4 years now? Okay, once we're able to answer that, once we're able to convert them into its equivalent present values, okay, present value, which means the value now, then that's the only time that we can accumulate these cash flows. Okay, let's assume for purposes of example that the present values are, let's say 1,200. If we added them, it turns out to be 1,200. So the net cash outflow is 1,000. The net cash inflow, and I say inflow because they are positive, is 1,200. Therefore, we have what we call the technical term for that is net present value, okay? And the net present value is 200, okay? So the decision rule, remember guys, we discussed this. If the net present value is greater than 0, then the project is okay. The project is feasible. That's the way, guys, we determine whether a project is feasible or not. Okay, number one, we look at the magnitude of the cash flows. So this has to be estimated, guys. Of course, the company has to do due diligence as far as estimating this cash flow. So it's not just the whim of the finance. It's really a team that looks at this. Okay, so and this cash flows comes from the estimated income statement. So they have first to determine, so what will be our estimated sales? What will be our estimated cost of sales? What will be the estimated costs of this sales, etc. And then they of course take into consideration interest. They take into consideration taxes to arrive at the net income after tax. And then this net income after tax is converted into cash flow. Okay, that's the only time that we get the projected cash flows, and then we have to convert them into present values. Once we have converted them into present values, then we can add them because they now based on a common time. Okay, so this is where the timing now comes into play. Okay, not only the magnitude, these are the magnitudes, but also the timing of the cash flows. Okay, so this is very important. Now remember, another way to do this is to compute for the IRR. And we can easily compute for the IRR. When we go to, in the next few sessions, we're going to look at that and use Excel. If, for example, the IRR of the project is 14% and the WACC was, let's say, WACC is 15%, then what will be our decision, guys? Accept the project or reject the project? return of the project of this project is 14%. The weighted average cost of capital is 15%. Kindly chat, please, guys. Kindly chat, please. And Leanne, thank you also for your answer. Okay. Maybe slow, but it seems to be stable. Okay. Okay. So now, because of that, guys, we will now be able to answer the question. Because if our answer is it might be slow and not stable, another person might view it differently. So there can be disagreements between that. So one solid way to answer this is look at the timing of the cash flows, look at the magnitude of the cash flows. Okay, that way, guys, we are on solid theoretical ground in determining whether this project is feasible or not. Okay, I have a pending question, guys. If the WACC is 15% and the IRR is 14% IRR of this project, are we going to accept the project or not? Chat, please, guys. Yes or no? Yes or no, please? IRR is the internal rate of return of the project. And if you recall, guys, we said that if the IRR, the return of the project, should be greater than the weighted average cost of capital. If the IRR is less than the WACC, then we reject the project. Okay, so what's our decision rule, guys? Okay, thank you, Leanne. That's correct, no? Reject. Thank you, Lance, Joan, and Kieran. Thank you so much. That's correct. Your answers are all correct. We should reject the project, guys. Why? Because the IRR, the return of the project, is less than the cost of acquiring the project. It doesn't make sense, guys, to push through with the project when the average cost of acquiring funds is 15% and the return of the project is only 14%. Okay, thank you for those answers. You're correct. Reject. However, we have a problem, guys, because the net present value is 200 and the IRR 14% is less than 15%. So the net present value concept says, yes, push through with the project. The IRR says, do not accept the project. So which will prevail? We have two measures here, guys, that are conflicting. Okay, so later on, guys, we'll learn that when the NPV and the IRR conflicts with each other, always follow the, what do you think, guys? Guess, guys? Guess? Could you kindly guess? Whom do we choose, the NPV or the IRR? Which measure do we choose? Okay, there's an answer here. Okay, thank you, Iana. Thank you, Kieran. However, the answer is always the NPV. Okay, thank you, Lance. Okay, you're correct. So always choose the NPV, guys. Why? I'm going to, it will require some knowledge on how we compute for the NPV and IRR. But suffice it to say now, guys, at the moment that the NPV is the more theoretically sound way to determine if a project is feasible or not relative to the IRR. Usually, guys, they agree. Usually, they will agree. But if they do not, guys, if there's a conflict between the output in terms of NPV and in terms of IRR, we follow the IRR. Sorry, the NPV, okay? All right, so that's a mouthful, guys, as far as the investment decision is concerned. Then again, for the financial decision, it's important to determine the optimal mix of debt and equity that maximizes firm value, and secondly, the matching principle. Long-term projects should be matched with long-term financing, and usually short-term should be matched with short-term financing, and sometimes a mix of short-term and long-term. What's important here is the long-term projects. Okay, you don't buy, for example, a big building using your credit card, because on credit card, guys, short-term lang yan, no? 1 year. Okay, in fact, 1 month nga lang. I-charge na tayo ng credit card company. We don't do that, no? For long-term projects, because it will stand to benefit the future years, then it's usually used with long-term financing. Okay, so please take note of this. The financing decision, okay, involves the optimal mix and the right kind of matching of your assets and your financing. Third, guys, dividend principle. Okay, the principle here is that if there are no projects, okay, that available now that yields the minimum acceptable greater than the WACC, then one good principle is to return the cash to the owners of the business. It will send a very strong signal, positive signal, that this company is able to generate excess cash flows. Now, of course, how much cash? That will be a very important decision, important study by the finance department. Okay, how much cash you can return depends upon the current and potential investment opportunities. Okay, how you choose to return cash will depend on whether they prefer dividends or buybacks. So this one, guys, we'll study this in greater detail. Okay, buybacks means the company buys back the shares of the investors. Okay, so these are the three principles, guys, that we looked at: the investment, financing, and the dividend. Okay, so this is just a repeat of what we discussed a while ago. All of these, guys, all of these decisions should focus on maximizing the shareholder wealth. Okay. Now, of course, there are corollary or related principles to this investment, financing, and dividend principles. Okay, number one, cash flow is king. I've been discussing this since we started. Okay, it means that all measures, everything is measured in cash. Okay, investments made, inflows, outflows, okay, all are measured in cash. Okay, and related to cash flow is king is that the time value of money. That 1 peso today is different from 1 peso after 1 year. That's why you were telling me a while ago that you would rather want 1 million now compared to 1 million after 1 year. Okay, so let me pause for a while. My question dito. Lian, could you kindly share your question to your classmates? Okay, this is a good question. Thank you much, Lian. What are the possible implications if the company does not return excess cash, instead they use it for other income generating purposes? Actually, guys, a company will have its yearly, it's required by law that the company should have their shareholders meeting. If this is well explained, I'm sure the shareholders will not mind. Because instead of returning the cash to them, if the company can invest in a project that earns, for example, 25%, okay, a company was able to determine or have a project that affords them 25% returns, instead of returning the cash to the shareholders, unless the shareholder has another potential project that earns more than 25%, then the shareholder won't mind. Okay, that's a very good question. So it's important for the firm to be transparent about their projects. So usually that's presented in the shareholders meeting. They give this proposal, this investment, and the estimated return of the project. So if the shareholders are aware of that, then they may expect that either there will be a reduced dividend distribution or no dividend distribution at all, because the company is going to use the funds to invest in that potential project. And if you were the shareholders, you would be happy, especially if the returns are good, and the returns and you cannot find on your own, okay, you cannot on your own find an investment that will provide that much returns. You will only mind, guys, if you say, there's a potential, I have a potential project where the returns is 50%. In that case, then guys, maybe the shareholders should sell their shares of stock and then pull out their money there and then put their money in that specific investment. Okay, Lian, did that answer your question, Lian? Okay, good. Thank you so much for asking that. Very good question. Okay, so another principle, guys, we go back here. Another principle, we discussed this before also, is a principle of risk and return. Okay, so what does this mean, guys? The higher the assumed risk, the higher the required return. Okay, let's have a case in point. Okay, so let's say we have two companies. Let's say Okay, we have here, let's say Globe, okay? So Globe has been in the business for several years already. And then we have here Dito. Okay, let's say both are in need of, let's say 100 million, okay? 100 million, okay? Both are in need of 100 million. And then, so one of them borrowed, let's say 7%, and another borrowed 7.5%. So both the term are 10 years, okay? 10 years. Parehong 10 years, monthly yung payment ng interest. Okay, so all the parameters are the same. 10-year loan, 100 million yung face, monthly yung interest. Okay, so my question is, which company is borrowing at 7%? Is it Globe or Dito? All things being equal. Could you kindly chat, guys? Which company is borrowing at 7%? Is it Globe or Dito? All things being equal. Guess, guys? Guess lang. Sige, please. Chat lang. Para may discussion tayo. Okay, thank you, Kiran. Thank you, Lance. Thank you. How about the rest, guys? Any guess? So Kiran guessed Globe, and Lance guessed Globe. Iana also Globe. Okay. Any more guesses, guys? Okay. Thank you so much, the three of you. You're correct. Tama, Globe. So may I ask Kiran, bakit Globe ang in-answer mo? Why did you say that it was Globe that was borrowing at 7%? Kiran? Okay, correct. Thank you. Sino pa? Si Lance. Bakit Globe? You can unmute yourself better.
Sir, I think what Kieran said, I think it's less risky,
Okay.
and I think I think Globe, particularly in the Philippines, is a bigger company.
Yeah. Okay.
So yeah.
Thank you. Thank you, Lance. Iana, same reason?
Yes, sir. Most likely,
Okay, sige. Thank you.
yung big company siya.
Okay, you're correct. The three of you are correct, no? Because it's very consistent with the principle of risk and return. As I said, all things being equal, Globe has been in the market for so long. So grabe na yung track record nila, no, of borrowing. Si Dito, fairly newcomer in the industry. So any finance, any lending institution, any financial institution, let's say banks or other lending institution, if the two of them will borrow from you, we know that we are assuming a greater amount of risk with Dito. Because they're just new in the market, they're not well established yet, and their track record of borrowing may not be that good. So in order to compensate for the higher assumed risk, you're correct. So if we lend to Dito, we will be assuming a greater amount of risk. Therefore, the sound principle is that we should be requiring the higher required return. Okay, because if Dito was to be borrow also at 7%, then why will I lend to Dito? Okay, a lending institution does not also have a infinite resource. So rather, it will lend its money to Globe because you're getting the same amount of return and less risk pa. Kasi Globe has been there in the business for so long. Okay, so that's what we mean by the principle of risk and return. Okay, and that's a well-established principle of finance. Okay, then another one, guys, is market forces, which tells us of the efficient market hypothesis. I'll discuss that in a while. And lastly, the agency problem, which if you have read your text, it has been discussed extensively, that nowadays, especially those that manage the business are professional managers, and the shareholders normally do not have any say in the ongoings of the business. Okay, so there might be an agency problem there. Okay, that's why there's what we call the principle of corporate governance in order to protect the interest of the shareholders. Okay, so what's one way? What do you think is one way of ensuring that managers will not do something that are inimical to the interest of the shareholders? Could you suggest something, guys? What's one suggestion by which this agency problem could be minimized? Any suggestion? Okay, so in the interest of time, guys, so let me just share this. Have you heard of this? The ESOP. Have you heard of this? Okay, my chat dito. Okay, thank you. All right. What's this? This is called the employee stock option plan. So this is the employee stock option plan. In this plan, okay, employees are given the opportunity to become shareholders of the business. Okay, so they're given stock options. So they could buy shares of stocks of the company where they're employed. And usually it's at a discount. Okay, so they're allowed to buy shares of stock of the company at a discount. So that way, guys, employees also become shareholders. And that, based on research, with this type of option plans, then the problems of the agency could be minimized. Kasi syempre yung employee, may stake na siya, owner na siya. Okay? So he does not want to destroy the company. More than just being an employee, no? A regular employee lang. Siya, employee na siya, shareholder pa siya. Syempre, he will benefit, guys, from the well-being of the organization more. Okay? So this is a very good plan, guys. Okay, thank you for your responses. It's called the ESOP, and there are other there are other ways by which agency problem could be mitigated or could be reduced. No? So we'll just stick to that first for a while. Okay, so let me just see. Okay, let me just budget my time. Okay, I have a few more slides. Okay, I intend to finish all of this, guys, kasi okay, this should end our discussion of chapter 1. Okay, so let's take a look at the first principle, guys, in terms of cash is king. Okay, when we talk of cash is king, okay, when we talk of cash is king, guys, the bigger the cash flow, the better. As far as the timing of the cash flows, the sooner, the better. As far as the risk of the cash flow, the less risky, the better. Okay, so very fundamental principles, guys, in terms of investments, in terms of cash flow being king. As far as the magnitude is concerned, of course, the bigger the inflows, the better. The sooner, the better in terms of timing. And in terms of risk, the less risk with that cash flow, the better. Okay, so that's our principle number 1, cash is king. Okay, now take note, guys, as far as cash is king, the principle tells us that cash flow is what matters. So accounting profit is not equal to cash. Take note of that. I've been harping on this before. Bakit hindi accounting profit? Why not look at the accounting profit? Okay, because institutions, players in the market does not provide the company with profit. What is provided, what flows between institutions, between organizations is cash. Okay, we know that, guys. It's cash flow that drives the value of a business. So when we make financial investment or financial decisions, what's important is what we call incremental cash flow. Okay, we're going to study this, guys, when we look at capital budgeting. Okay, incremental cash flow. Okay, number 2, guys, just a quick review, the time value of money. Okay, 1 peso received today is worth more than 1 peso received in the future. That's why you told me a while ago, you would rather have that 1 million now compared to 1 million in the future. Okay, now interest on money can earn interest also. That's better to receive money now than 1 year from now. So this is very consistent. If you have 1 million now, you can put it in an investment and it will earn interest, and the interest can earn interest also, so that after 1 year, you have a cash flow that's greater than the 1 million after 1 year. Okay, so that's very basic, guys. Money has time value, money has cost. The third principle is that risk requires a reward. It doesn't make sense, guys, to take on additional risk, okay, if we are not compensated for it. Case ni Globe at saka Dito. Why will lending companies lend to Dito at 7%, and when Globe is also borrowing 100 million payable in 10 years, monthly interest payments at 7%? It doesn't make sense, guys. We know that by lending to Dito, we might be assuming a greater amount of risk. So we should be compensated for that. Okay, that's a fundamental principle of finance. The greater the risk, assumed risk, the greater is the greater should be the required return. Okay, investors expect to be compensated for delaying consumption and taking on risk. Okay, so that's risk and return principle. Okay, number 4, principal prices are generally right. So if you go to you invest, guys, you want to invest in the stock market, okay, the prices of these assets like bonds, okay, stocks, already reflect all available information about the asset, and there's a principle about that, and it's called the EMH. Okay, efficient market hypothesis, EMH. And I'd like you to read about this. There are 3 types of efficient market hypothesis. I want you to research about that first. It's very important that the market should be efficient. Okay, it means that when you look at the stock market, yung prices ng mga stocks dun already reflect all available information. Because if not, guys, then that means there are some privileged group who enjoy some information which the ordinary investors do not. And if it's like that, guys, then the market will collapse. Why will the market collapse? Because nobody will trust it. Nobody will trust the market. It's important that the market is transparent. It's important that whatever price reflected there, it should include all available information. Okay, so stock prices in the market are useful indicators of the value of the firm. So generally we can trust that the price in the stock market is really the value of the firm. Okay, take note, guys, the price is not equal to the value. Okay, generally. Okay, but for the price is the amount any investor is willing to pay for that stock. The value is the worth of that stock based on computations. Okay, so if the price reflect all the information available in the market, then investors would be able to make good decisions. Okay, good decisions which eventually will increase the stock price and increase expected cash flows. Okay, so I'm putting here, for example, this is a site, guys. So let me just flash that. Okay, here. Okay, so example, guys, ito yung stock, ito yung this is the stocks that are traded in the Philippine Stock Exchange. Okay, so for example, this one. Yung last price ni Aboitiz was 50.50. Aboitiz Power 31. Let's see. Si Globe is 3,016. Okay. Jollibee is 228. Manila Electric is 294. The efficient market hypothesis tells us that these prices reflect all available information. Because we can trust that this price is approximately equal to the value of the firm. Now, again, that's very important because if investors would invest in the Philippine Stock Exchange, kailangan may trust, they should have that trust that these prices contain all the relevant information. Okay? Otherwise, kung may mga nakatago na information na hindi available to shareholders, then as I said a while ago, the market will generally collapse. Okay? All right. So, last principle, guys, ito, yung conflicts. Conflicts, no? Yung agency principle. Conflicts of interest can cause agency problems. And we mentioned a while ago that one way to address this is the ESOP, Employee Stock Option Plan. There are also other ways in order to avoid problems like this. That's why very important yung corporate governance, guys, because corporate governance seeks to protect the interest of the shareholders at large. Okay. Now, just to conclude, guys, corporate finance, it's really common sense. No? There's nothing earth-shattering in the obvious statements below. For example, if we make investments that make 12% with funds that cost 11%, then that's good. So nothing earth-shaking about that. No? Nothing so ooh or aha about that. No? Any investment that we make should have a return that should be greater than the hurdle rate. Ito, 12% investment, okay yan, because the WACC is 11%. Okay. Second principle, common sense nito, it is better to find a funding mix which costs 12% instead of 13%. Financing decision yan. So which is better? Pag ang kunyari sa debt, no? The cost of debt is equal to, let's say, 13%, as compared to being able to acquire a debt of the same amount, guys, at 12%. Siyempre, guys, obviously, it's better to find a funding mix that costs cheaper instead of 13% vis-a-vis 12%. That's part of the financing decision. Okay, and also another obvious thing, positing that if most of your investment opportunities generate returns less than your cost of funding, it's best to return the cash to the owners of the business and shrink the business. What does this mean? Kung wala namang investment opportunities available, then it will be better to return the cash to the owners of the business and shrink the business a bit. Returning the cash kasi to the business will mean shrinking the business a bit, no? Kasi you will be returning excess cash. Okay, these principles make common sense, guys. There's nothing so rocket science about these things. Okay, so last few slides. Number 2, so not only is it obvious, so it's common sense, it's also focused. So what do we mean by focused? There's a singular objective, and it's to maximize shareholder value. So it's not to maximize customer satisfaction. It's not to maximize profit. It's not to maximize supplier satisfaction. Hindi eh. The objective in corporate finance is singular, to maximize shareholder value. We're not saying the other objectives are not important, but what we're saying is the main objective should be the maximization of shareholder value. Okay, with this singular objective, the focus can be on choosing the right investments, okay, given a menu of such rules. Okay, what do you mean by that? So for example, if the projects are mutually exclusive, then of course choose that project which generates the greatest NPV or greatest IRR. Okay. What does having a singular objective also mean? It also means determining the right mix of debt and equity, and examining the right amount of cash that should be returned to the owners, okay? And the right amount of cash to be held back as cash balance for flowing back to operations. So focus talaga, guys. So again, we go back to the investment, financing, and dividend decision. Okay, and lastly, it's universal. Okay, so what do you mean by universal, guys? Small businesses, large businesses, public or private, any business in the mature market or emerging market, all of this, guys, all of these projects have to come up with investing, financing, and dividend decision making. Okay, the objective for all this type of businesses, whether it's small or large, etc., is the same: the maximization of shareholder value. These principles are universal, and that's what's good with corporate finance. Okay, now of course the constraints and challenges may vary dramatically across firms. However, there are principles that do not change. Okay, so what does this mean? A publicly traded firm with its greater access to capital markets and more diversified investor base may have much lower cost of debt and equity than a private business. But they both should look for the financing mix that minimizes their cost of capital. So kahit na publicly traded ka, which means your firm is being traded in the stock exchange, or private, which means your firm is not being traded in the stock exchange. Okay, a publicly traded firm may have a more diversified choice of financing as compared to a private business. However, nonetheless, guys, they should look for the financing mix that minimizes their cost of capital. Okay, pareho lang, it's the same. Then, a firm in an emerging market may face greater uncertainty with respect to new investments compared to a firm in the developed market. However, whether you're in the emerging market or a developed market, you should only invest in projects where the returns are higher than their respective hurdle rates. So the same, guys, the same principle that controls this. Okay, it's already time, guys. May I have just one or this is the last slide. Okay, so at this time, guys, okay, may I request you to read on this, yung VUCA principle. Any businesses, guys, okay, I'm sure you have heard of this, that yung VUCA principle, guys, any business now is exposed to very volatile, no? Very quick changing dynamics ng industry, very uncertain, very complex, very ambiguous yung market. Gone are the days when napakasimple lang ng market, very easy to please customers. Ngayon hindi na, guys. Businesses are exposed to what we call the VUCA world: volatility, uncertainty, complexity, and ambiguity. Okay, with that, guys, let me end this. I'll stop recording now.